Hi, I'm Chris Mangrobang, a transfer pricing lead senior manager here at Exactera. I have 17 years of experience, the bulk of which were in Canadian transfer pricing. So let me talk about that. Now, the CRA can be a rigorous tax authority, that's the Canada Revenue Agency, and transfer pricing documentation, once requested, are highly scrutinized, so taxpayers have to be careful, really careful in complying with Canadian TP regulations and documentation requirements. Now, currently, only a local file is required to document cross-border intercompany transactions in Canada. Like any TP report, it must contain background information of the corporate group, the local Canadian entity, and the related parties it transacts with, functional analysis and economic analysis, or sometimes referred to as the benchmarking. There is currently no master file requirement in Canada. But currently, Canadian tax authorities are considering requiring the master file for corporate groups who filed the CBCR, that's the country-by-country report, or groups that have group revenues of at least 750 million euros. Canada endorses the country-by-country report and has published a guide devoted to reporting and notification procedures for any CBCR filer. So generally, just in a nutshell, companies who belong to a CBCR reporting group, 750 million euros in revenues, they need to file a notification with the CRA. Now, let us go back to the local file. Canadian local entities are required to submit the TP report when requested by the CRA within 3 months from the date of request or when you receive notification. There is no extension to this 3-month deadline, and failure to comply could result in significant monetary penalties. Having said that, the entities need to prepare the TP report contemporaneously. That is, the report must be completed at the time of the filing of the Canadian tax return for the fiscal year covered. It's actually 6 months after the company's financial year end. In fact, in this very same Canadian tax return, there is a question whether or not the TP documentation has been prepared at the time of the filing of the return. Now, trust me, you want to be in a position to answer yes to that question. The CRA can be pretty much focused on transactions that attract its attention, but usually, intercompany services, royalties, financial transactions, and other complex transactions can invite a higher level of scrutiny. But that does not necessarily mean that one focuses less on other transactions. Other situations that can increase the likelihood of an audit, of a TP audit, could include new significant transactions, operating losses, saying no to that documentation question on the Canadian tax return, restructuring that could suggest significant movement in functions and risk, etc. In June 2023, the Federal Ministry of Finance, the one that oversees the CRA, released a discussion paper that seeks to introduce significant changes to Canadian TP legislation. Now, some of the notable proposals include a consistency rule to make the Canadian TP legislation applied in a manner that is aligned with the OECD TP guidelines. Another one is the rewriting of the recharacterization provisions of the Canadian Income Tax Act to provide conditions when recharacterization is appropriate, and also examining and documenting intercompany transactions on factual facts instead of intercompany agreements. But probably for our listeners, the more important changes proposed are, there's a proposal for safe harbor returns for routine distributors and low value added services, also requiring the master file for CBCR filing entities, which I mentioned earlier, increase the absolute threshold penalty from $5 million to $10 million in adjustment, simplified approach where smaller taxpayers fill out annual schedules listing their intercompany transactions, their dollar amounts, and the TP method used. So far, no guidance has been issued yet. These are just proposals. And lastly, the use of credit rating approach for intercompany loan transactions. Now, what mistakes do I see when complying with Canadian TP documentation? Now, the CRA has explicitly given examples of cases that were referred for TP penalties in its Transfer Pricing Memorandum 9. Notable examples include no existing files to support the determination of management fees, ignoring perfectly good internal comparables and using low-ranked TP methods, numerous adjustments over several years made to adhere to the transfer pricing policy that was claimed to be in place, and the taxpayer did not prepare a detailed TP study as the revenues of the Canadian taxpayer were thought to be relatively insignificant when compared to the overall worldwide group operations. Now, how do you avoid mistakes like that? Canada has a reasonable effort standard. or the degree of effort that an independent and competent person engaged in the same line of business or endeavor would exercise under similar circumstances. What is reasonable is based on what a reasonable business person and taxpayer circumstance would do, having regard to the complexity and importance of the transfer pricing issues that arise in the taxpayer's case. So make sure of this. Be reasonable in your efforts in documenting your transactions. In summary, though, a robust TP report prepared contemporaneously is your best defense. Now, thanks for watching. If you like more advice on transfer pricing in any country, get a free consultation with one of our experts.